must be won each day and each night, through darkness and through light. Cry it out to the world, spread the word.
A'udhu billahi minash shaitanir rajeem. Bismillahir rahmanir rahim. Rabbi shrah li sadri wa yassir li amri wahlul 'uqdatum min lisani yafqahu qawli. Nahmaduhu wa nusalli ala rasulihil kareem wa amma ba'd. Assalamu alaikum wa rahmatullahi wa barakatuh. Dear brothers and sisters, we were discussing in the last episode about various differences between the conventional bank and the Islamic banks. Most of the people have this misperception that the Islamic banks basically are doing the same thing as conventional banks do. And the aim of this program we have started on Peace TV is to let people know as to what exactly happens inside an Islamic bank, so that they do not think that Islamic banks and the conventional banks are one and the same. And this is only a facade that the Islamic banks have so that they can get the money from soft-hearted Muslims, so that they avoid riba. And in the earlier programs we have also learned how detrimental riba is for humanity, not only for this world but also the hereafter. So a lot of people, when there were not many Islamic banks, they had no option. They were forced to keep their funds either at home, which was inviting risk, or with the conventional banks. But when they were doing that, they were actually keeping the funds either in the current account so that they don't get any interest, or even if they were keeping it in the deposit accounts, perhaps they were discarding the profit and giving it to some people, or they were telling the bank, please don't give us any profit or other interest. The people who did not have much choice earlier on, when there were not many Islamic banks, they were forced to keep their money with the conventional banks, but most of them were keeping the funds in current account. And even if somebody was keeping funds with the, I'm talking about those people who wanted to get away from riba, but they had no choice, because if they keep large amount of money at home, and they may be inviting trouble. So they used to keep with the banks, but the conventional banks, but they used to keep funds either in the current account, or if they were keeping in saving accounts or fixed deposit accounts, either they were telling the banks not to give us any interest, or they were telling them, okay, give us the interest, and then they used to give away the interest for some charity work. That reminds me of a situation when I was in a conventional bank. There was a depositor who used to tell us specifically a big amount of money used to keep with my bank, because I have worked for a very long time with conventional banks. So he used to keep large amount of money, and he used to tell my branch manager that please don't give me any interest, but could you gift me a Mercedes on a yearly basis. So for him, actually it was not interest. Getting a car, a Mercedes new car from the bank as a gift, and bank was happy doing that, because bank used to keep the entire money in the current account, make a lot of money out of that, and a fraction of that they used to go and buy a brand new Mercedes and gift it to this gentleman. And he used to think that, well, what he is getting is not riba, but definitely it was riba, one kind of riba. In the current account, basically you are actually keeping the funds not to get any return, and then in return you are getting a car. So either you get this much or you get this much is riba. Either you get in shape of cash or you get in shape of kind, any gift or anything. Also, definitely this is also riba, one kind of riba. So anyway, coming back to our subject, the previous episode clearly explained and made it clear that the Islamic banks have a very strong corporate governance model. And not only the Sharia board and the Sharia auditors, but also Sharia principles itself. The Sharia principles are, we discussed earlier, are God-made. Allah subhanahu wa ta'ala has crafted the financial system for us. We have to simply follow that. We are not authorized, or we are not allowed to invent something new in it. Invention, when we talk about the innovation in Islamic finance, that is a separate thing altogether. It means that you are actually using the existing structures to meet with the complex requirement of a client. For example, if you talk about the greenfield industry setup, then obviously one structure will not do. So you have to innovate in a sense that you take different structures, investment structure, sales structure, leasing structure, and then combine and then meet with clients' requirements in a manner that the client is happy that all his requirements are being fulfilled. So this is innovation. But you cannot add something or you cannot subtract something from already existing Sharia principles. So this is the corporate governance level that we have. In addition to that, there is an IOF standards. The Sharia standards taken out by the IOF, which is the standard setting body which is based in Bahrain, and the full form of IOF is the Accounting and Auditing Organization for Islamic Financial Institutions. What is this body and what does it do and who is running this body? The bodies actually have its own Sharia board, and the Sharia board is represented by the scholars from almost all parts of the world. The Sharia board is very exhaustive, very wide, and it has got scholars coming from Saudi Arabia, coming from UAE, Qatar, Bahrain, Kuwait, and on the other side from India, Pakistan, Malaysia, Indonesia, from US, from UK. So this basically is the standard setting body which actually has really done a great job in giving the Islamic financial institutions a benchmark to follow. And this basically is the Sharia standard which deals with anything an Islamic financial institution does or will need to do. If an Islamic financial institution would like to spread the wings, it can have a lot of other structures and a lot of other investment vehicles. But then the Sharia standards taken out by IOF actually is the benchmark as to if you do any sukuk based on istisna or ijara or musharka or mudarba, these are the standards on which all the scholars from around the world have signed up. It means they have signed up all the standards which are there. The need of the hour is to actually apply those standards in every financial institution, Islamic financial institutions, so that they have a level playing field, and then when one institution takes out a product or a structure or a transaction, invites other Islamic financial institutions to invest in that, they don't have to reinvent the whole wheel and then go through the checking process whether the structure is as per the Sharia or the documentation is as per Sharia or not. So this is the great work that these scholars have done in giving us the benchmark standards. And then the same organization has also taken out the accounting standards. And the accounting standards are actually telling you how to record a transaction. The transaction for sale, for example, murabaha, how it should be recorded, because first you get the goods or the commodity or the asset, purchase it from the third party, so the possession comes to you, the ownership comes to you, to the Islamic financial institutions, so it should be shown in the balance sheet as its ownership. And then it is sold to the client, so the asset or the goods or commodity is converted into a debt. You see, the Sharia basically has debts which result, as a result of the transaction, the debt comes out. In this case, we talk about the murabaha. Murabaha is basically resulting in a debt on the buyer. The buyer will buy the goods on deferred basis and will, pay to the bank. So they have got the accounting standards, how to record all this. So Sharia standards, accounting standards. Then we have got the Islamic Financial Services Board. What is that? The Islamic Financial Services Board is a body based in Malaysia which has come up with the regulations how to deal with the risk management, how to deal with the capital adequacy. Capital adequacy in a conventional bank is totally different than the capital adequacy in an Islamic bank. Let me explain. In a conventional bank, the capital adequacy ratio is determined based on the capital which has been invested by the shareholders. Okay, fine. That is okay for the conventional bank. they do not let the conventional bank to receive the deposits beyond a certain threshold, because the capital of a conventional financial institutions is this much, so you can only get this many times deposits so that you can manage it. In case of Islamic bank, this is not the case, because we are talking about the equity, the capital, which is invested by the shareholders originally, but then when they become the mudarib, when they invite the depositors to come and invest with them, what do the investors bring? They don't bring loan, they bring capital, they bring equity. So it means we're talking about the combination of equities. One equity coming from the shareholders, the other equity is coming from the depositors. So both are investing their equity. Remember I explained earlier that the depositors, they simply part with the possession of the money by retaining the title. It means it is their equity. So if this is their equity, this is a big risk pool, the common pool. When you talk about the big risk pool, the Islamic financial institution is not responsible if the pool loses some money on account of some unforeseen situation. The pro rata effect of this loss will be taken by the shareholders and the depositor. The shareholders will lose from their amount which they have invested in the common pool. The depositors will lose from their, it will be pro rata. Similarly, when we talk about the profit the common pool will generate, the profit will also be distributed as per the agreed ratio. When we come to the profit distribution in detail, I'll explain to you how it is taken care of. Now we are talking about the corporate governance. So we're talking about the shareholders general assembly, we're talking about the Sharia board, we're talking about the board of directors, we're talking about the Sharia standards, we're talking about the accounting standards, and we are talking about the IFSB, which is the Islamic Financial Services Board. Look at the fascinating aspect of the corporate governance in an Islamic bank, which we don't have in the conventional financial institutions. So the depositors are at the mercy of the board of directors or of the management, and they will not be able to get as much protection as they will have with an Islamic bank. And not only that, what about the return? As I explained earlier, the depositors of a conventional bank are limited in getting the return, but when it comes to the return given to the depositors of an Islamic bank, the more the merrier. It means they are there in it to share it with the Islamic bank, with the mudarib, with the shareholders. So here the model is completely different. And as we talk more and more about differences between the Islamic and conventional banks, it will be much more clearer to you that Islamic banks are investor friendly. Islamic banks are basically providing greater return to the depositors. This is the myth when we say that the title is withheld by the depositors of an Islamic bank, so they part with the possession only and then they are taking the risk and they might lose the entire capital. This is basically a myth. Why? Because after explaining to you so many rules and regulations, it should be very clear to you that Islamic bank cannot take it for granted. The money which has come to it as a trust money, the grip of the trusteeship is very strong in Sharia. And that's why no Islamic bank has been able to, incur a loss due to its intention. And then the time has come to take a short break. And when we come back, we'll continue with the discussion. Please stay with us.
Spread the word of Islam.
Assalamu alaikum wa rahmatullahi wa barakatuh. Thank you for coming back. Before we went to break, we were discussing about the myth that the depositors of an Islamic bank, they hand over their money to the Islamic bank, and because they have not handed the title to the money, they are exposed to the risk of owning the money. So if the Islamic bank will invest their money and will lose it, they will lose it. It's not that easy. We have explained in detail as to how an Islamic bank operates. There are so many layers of corporate governance. And keeping this in mind, you can imagine as to how Islamic bank functions. Definitely, there are losses in Islamic banks. We are not denying that, as there are losses in conventional banks. But the losses in Islamic banks are genuine, and as such, the Islamic bank and the depositors pro rata are bearing those losses. So if the common pool funds have been invested in different, for example, there are thousands and thousands of depositors, and there are thousands and thousands of entrepreneurs or people who need finance from Islamic bank. So once the money comes to the Islamic bank in the common pool from the depositors, and then the Islamic bank, being the manager of the common pool, will invest that money down the line in different transactions. Some transactions are bound to fail. Some transactions, it's not necessary that 100% successful investments will be made. This is exactly what is Sharia all about, that you are basically investing your equity and you are exposed to the risk of equity. And this is this is part of the game in equity investments. So we are talking about the equity which is being invested, and maybe it is possible that some of the investment goes sour. So if those investments don't come back to the common pool, then there is a loss. The mechanism of the common pool is such that there are thousands of transactions being invested on a daily basis, and thousands of them are coming back to the Islamic bank having been matured. The funds will come back with profit and then will be reinvested. So this is an unending cycle which is going on, because Islamic bank is an ongoing concern. If, for example, in an ideal situation, if the profit of an Islamic bank will be to this extent, if there is no loss, but because of certain losses, the profit has reached this level. So it means that we have not reached the ideal situation. This is not the ideal world, mind you, but we have received this much profit. But still there is a profit. This is the zero, and this is from here to here, you can see the profit. So it means that the distribution which will take place, whatever profit has been earned and realized, will be actually distributed between the depositors and the shareholders. On an ongoing basis, we haven't seen any Islamic bank which has said, well, sorry, there has been a huge amount of loss and will not distribute. If the Islamic banks would be investing in those toxic instruments and subprime, maybe they would have told their depositors, but alhamdulillah, by the grace of Allah subhanahu wa ta'ala, this is a no-go area for us. So we basically did not go there at all, and that's how we survived this crisis. The amount of loss which is debited to the common pool by way of provisions is pro rata distributed between the, automatically, this is by default, it is distributed pro rata between the depositors' deposit and also the shareholders' deposit, both pro rata absorb it. Another extension of this discussion is that when the finance department of an Islamic bank will prepare the profit distribution, then the losses or the provisions are checked thoroughly by the Sharia auditors, because that is an area where they need to be sure that the losses which happen were genuine losses. If there is some kind of ingenuine loss, then how to deal with that? The ingenuine loss means that due to the negligence of one of the staff, or due to the miscalculation, maybe the risk department did not, or investment committee did not look at it properly, and they missed out some vital element and they invested the amount into the instrument, and then it turned out to be a loss. So once the Sharia auditors have done their thorough examination, they will submit their report to the Sharia board. It will be the Sharia board members, not the Sharia auditors. The Sharia board members who will table the matter, and then they will discuss, and then they will, because they are the people who are knowledgeable people. So they will threadbare, they will examine, and then they will make a decision, and they will instruct the management of the Islamic banks whether to treat it as a loss due to negligence of the mudarib or due to the innocence of the mudarib. It is possible, innocent losses are possible, and they are happening sometime. The deposit basically which is coming to the Islamic bank will be benefited if there are some kind of ingenuine losses. So those losses are separated and debited to the shareholders' account, and then the profit distribution for the pool will go up. So here there is a very, very thorough check and balance which basically Islamic banks are doing. Another difference between the Islamic bank and a conventional bank is about the license which the regulatory authorities issue to conventional bank and the license which the regulatory authorities issue to the Islamic bank. When a conventional banking license is issued to a conventional bank, the conventional bank is clearly told that we are giving you the license only to borrow money from the depositors on interest and lend the same money to the borrowers on interest. You are not allowed to trade with the depositors' money. Now, what does that mean? It means that the conventional bank is not allowed to go to the stock market with that money and do trading in shares. It is not allowed to buy and sell the goods and commodities and buy and sell the assets. No. It is only allowed to get the money from the depositors on interest and to lend it on interest. That's it. If they want to do any kind of trading, they can do with their residual capital, share capital, or the retained earnings or some reserves which are with them. In some jurisdictions, the reserves also are untouchable, so you cannot lay your hand on that. But basically the residual share capital, which is in shape of money, they can use that money to do trading in different assets and also the shares or whatever. The difference, in the Islamic banks is that when a regulatory authority issues a Islamic banking license, it tells the Islamic bank that you are allowed to trade with the depositors' money, but you're not allowed to borrow money from depositors on interest and lend money on interest to the entrepreneurs or the borrowers. We are talking about differences between conventional and Islamic. So many differences have come out so far. This is another difference, that the conventional bank is not allowed to trade with the depositors' money, whereas the Islamic bank is allowed to trade with the depositors' money because it is equity. In case of the conventional bank, why they are allowed to trade with their own money is because it's their equity. Here, the Islamic bank's equity is its own residual share capital plus the amount which they get from the depositors. That is also an equity. So they are allowed specifically to trade with that, because this is the only way the Islamic bank can make money, because Islamic banks will use that deposit money to buy the asset and lease them, to buy the goods and sell them. For example, cars, purchase the cars and sell the cars, purchase the real estate and lease the real estate, purchase aircrafts and lease it to airlines, purchase the marine vessels, for example, buy it on a istisna basis from the shipbuilding companies and then lease it to the client. And there can be many situations where the Islamic bank either is purchasing by using the depositors' money, purchasing the asset and selling it and leasing it and making money for the common pool. And also the Islamic bank is also authorized to invest in the client's businesses, the equity which it is getting through the common pool. So it means it becomes an investor also in their businesses. So many aspects are open for an Islamic bank, but one aspect which is not open for Islamic bank, which is closed completely, is they cannot lend money on interest and make money out of that. This is not allowed, because obviously Sharia will not allow them. But the regulatory authorities keep in the license this condition that they cannot do that. Thank you very much for joining us for this episode. We'll continue with this discussion, inshallah, in the next episode. Assalamu alaikum wa rahmatullahi wa barakatuhu.
Spread the word, oh man. Spread the word of Islam. Oh, fortunate one. Paradise must be won. Paradise must be won. Each day and each night, through darkness and through